Imagine opening a company's annual earnings report and, seeing this massive flashing headline, like 142% revenue growth.
Right, which is just huge.
It's massive. Your first instinct is probably that this business is absolutely dominating its market.
Yeah.
But then you flip to the footnotes and you realize they just posted a net loss of nearly $300 million.
Yeah, that changes the picture completely.
Exactly. And their internal accounting controls are flashing these major warning signs. Oh, and a major company that just acquired went totally bankrupt within months.
It creates this massive sense of cognitive dissonance. I mean, you are looking at a single organization that is simultaneously projecting unprecedented momentum on paper while, managing what looks like an operational catastrophe behind the scenes.
Welcome to the deep dive.
Yeah.
Today, we're opening the books on Nano Dimension. They're an advanced 3D printing and digital manufacturing company, trading under the NASDAQ ticker NNDM.
Yep, NNDM.
And just so you know, our source material for this analysis comes directly from their Q4 and full year 2025 earnings press release, the accompanying financial tables, and the actual official earnings call transcript from March 31st, 2026.
And the documents from this specific reporting period are just fascinating. They really force you to look past the heavily curated corporate narrative,
Oh, for sure.
They offer this rare, completely unfiltered look at the actual mechanics of corporate growth and really the immense friction that occurs when you try to buy your way to scale.
Right, and that's exactly our mission for this deep dive. We want to explore how a company navigates the turbulent waters of aggressive acquisitions, subsidiary bankruptcy, and, well, cutting-edge defense technology.
It's quite the mix.
It really is. If you're reading these numbers alongside us, you might initially think this company is taking over the world. But wait until you see what we found buried in the footnotes. I mean, it is a masterclass in reading between the lines of financial reporting.
It really is.
Okay, let's unpack this, starting with that staggering growth metric.
Well, the surface level numbers are obviously engineered to command attention. I mean, the very first bullet point of their press release highlights a Q4 2025 revenue of $35.3 million.
Which sounds great.
It does.
Right.
That is a 142% increase from the $14.6 million they reported in the exact same quarter the previous year. And if you zoom out to the full year, revenue hit $102.4 million, which represents a 77% jump.
See, those are the kinds of numbers that typically send a stock soaring.
Right.
But the underlying mechanics of how they actually achieved that growth, it tells a completely different story.
Yeah.
This was not a case of Nano Dimension suddenly finding a massive new customer base for their existing 3D printers.
Not at all. The revenue spike was almost entirely purchased.
Right.
So in April of 2025, Nano Dimension acquired a company called Markforged.
Right.
And if you bypass the PR spin in the press release and go straight into the raw financial tables, you can isolate the specific contribution of that new acquisition. In the fourth quarter, Markforged was responsible for $20.7 million of that total revenue.
Okay, wait, let's do the math on that. Because if you take the $35.3 million total and subtract the $20.7 million that came from Markforged, Nano Dimension's standalone, core revenue was roughly $14.6 million.
Exactly.
Which means their organic growth, the actual sales momentum of the company they were before the acquisition, was entirely flat compared to the prior year.
Flat year over year, despite all the capital deployed. And the situation becomes even more complex when you analyze the performance of the company they bought.
Oh, right, the Q&A session.
Yes. During the Q&A session of the earnings call, an analyst named Moshe Sarsadi from Merchant brought this exact math to the forefront. He pointed out that if you look at Markforged's standalone revenue compared to their pre-acquisition numbers the previous year, Markforged actually experienced a decline in sales.
Yeah, the analyst did not hold back at all. He openly accused the company of issuing a misleading press release.
He used that exact word. Right, misleading. Because they led with a 100+% growth figure that heavily implied organic momentum, when in reality, they basically combined a flat core business with a declining acquired business.
And CEO David Stellan, to be fair, defended the reporting structure by pointing to accounting regulations. Under corporate reporting standards, a company is legally required to present consolidated financials.
Right, GAAP rules.
Exactly. Once you acquire a business, their revenue is integrated into your top line for year-over-year comparisons. So the CEO's argument was that they were simply following standard compliance, rather than, attempting to obscure the reality.
Sure.
And to address the analyst's concerns about actual momentum, Stellan just shifted the focus away from the year-over-year numbers. He pointed to sequential growth, instead highlighting the revenue increase from Q3 to Q4 of 2025 as evidence that the newly combined company was stabilizing. You know, it's a bit like boasting to your friends that your household income doubled this year, but omitting the fact that it only happened because you just got married to someone with a great job, while your own salary actually stayed exactly the same.
That's a great way to put it.
And on top of that, your new spouse's salary is actually slightly lower than it was last year. Like, sure, legally and for tax purposes, your household income doubled, but it paints a very different picture of your personal career trajectory.
And that analogy perfectly illustrates the danger of taking headline growth at face value. When revenue is acquired rather than generated organically, the next logical step in analyzing a company is to look at the actual quality of the assets they purchased.
Which takes us right out of the realm of clever accounting and straight into what looks like an operational disaster. Because Markforged wasn't the only major check Nano Dimension wrote in the spring of 2025.
No, it wasn't.
They actually closed 2 massive acquisitions in April. The second was a prominent player in the space called Desktop Metal.
And acquiring one publicly traded technology company requires a massive integration effort. Attempting to absorb 2 simultaneously Markforged and Desktop Metal, it just places an unimaginable strain on a company's legal, operational, and financial infrastructure.
And that strain became apparent almost immediately. Within months of the acquisition finalizing, Desktop Metal completely collapsed.
Yeah, they filed for Chapter 11 bankruptcy.
But if a company buys another company that literally goes bankrupt within months, doesn't that raise massive questions about their due diligence?
Yeah.
Like, how do you even integrate a company while the other one you just bought is legally collapsing?
This raises an important question about the hidden risks of aggressive M&A strategies. The true cost of an acquisition is rarely just the purchase price.
Right.
It is the systemic shock to the acquiring company's internal systems. The mechanics of untangling a bankrupt subsidiary are brutal. Because Desktop Metal entered Chapter 11, Nano Dimension lost operational control. Yeah, they had to physically separate Desktop Metal's financials from their own by the third quarter of 2025. In accounting terminology, this is recorded as a discontinued operation.
And the financial penalty for that failure is sitting right there on the income statement.
Yeah.
That single discontinued operation resulted in a staggering $193.2 million net loss.
Huge hit.
It essentially vaporized any potential value from the deal. It pushed Nano Dimension's total net loss for 2025 to an astonishing $293.6 million.
And we see the evidence of that internal shock in Nano Dimension's 10K filing, the comprehensive annual report detailing their business operations and risks. The auditors actually flagged a material weakness in the company's internal controls over financial reporting.
Okay, for someone who doesn't read 10K filings for fun, what does a material weakness actually mean in practical terms? Because it sounds like a massive red flag for investors.
It is a significant red flag. A material weakness basically means the auditors believe there is a reasonable possibility that a major error in the company's financial statements will not be prevented or caught in time by the company's own accounting team.
Yikes.
Yeah. The filing specifically noted that this weakness was caused by resource limitations. They simply did not have the internal bandwidth or the specialized personnel to properly account for the immense complexity of simultaneously integrating Markforged and dealing with the valuation analysis of the collapsing Desktop Metal deal.
So they basically stretched their accounting team so thin that the systems designed to ensure the math was right fundamentally broke down.
Exactly.
Now, management was quick to clarify that no past financials actually had to be restated, so they aren't saying the old numbers are wrong, and they have initiated a remediation plan under their audit committee. But it highlights a massive disconnect.
How so?
Well, you have an administration struggling to execute on the corporate side, sitting right next to an engineering team that is producing undeniable technological advancements.
And that disconnect is the core tension of the entire earnings report. If you solely evaluated Nano Dimension based on their corporate maneuverings in 2025, the picture is incredibly bleak.
Right.
But when the earnings call pivots to the factory floor and the actual applications of their hardware, the narrative completely flips.
Let's test if absorbing that $300 million loss was worth it, because the hardware they are deploying literally challenges traditional supply chain logic.
It really does.
They outlined several manufacturing platforms on the call, including the X7 and the FX20, but they spent a significant amount of time focusing on their newest system, the FX10.
The FX10 is fascinating.
Yeah, it's the world's first industrial platform capable of printing both high-performance composite materials and metal parts on the exact same machine.
And the engineering required to achieve that is incredibly complex. I mean, traditional manufacturing relies on entirely siloed processes.
Right, because metal needs extreme heat.
Exactly. Metal requires extreme heat, lasers, or sintering processes, whereas composite plastics typically involve extrusion or chemical binding. So combining those into a single chassis means managing vast temperature differentials and complex tooling swaps without losing microscopic precision.
That sounds like a nightmare to engineer.
It is. But by achieving this, the FX10 allows a manufacturer to consolidate their floor space, reduce the number of distinct supply chains they manage, and rapidly iterate on a design using different materials without moving the project to a different facility.
And they aren't just selling standalone hardware either. They tie all of these machines together using a system called the Digital Forge.
Yes, the Digital Forge is the software architecture that makes the hardware viable for high-level enterprise and government clients.
Yeah.
It integrates the 3D printers, the specialized raw materials, and a highly secure, cloud-based network.
So it's an entire ecosystem.
Right. And this structure guarantees data integrity. If an engineer in one location designs a part, the Digital Forge ensures it prints with the exact same structural properties and tolerances, regardless of where the physical printer is actually located in the world.
And that level of encryption and repeatability totally explains their target demographic. They're heavily focused on aerospace, automotive, next-generation computing data centers, and the defense sector.
The defense sector is key here.
Yeah. The CEO shared a specific deployment of the FX20 system that really illustrates why this tech is so critical right now. They currently have FX20 machines operating alongside U.S. and allied military forces in Europe.
If we connect this to the bigger picture, the concept of manufacturing at the tactical edge is transforming military logistics.
The tactical edge.
Yeah.
Yeah.
In a contested environment, the traditional supply chain is a massive vulnerability. If a drone or an unmanned system sustains damage, waiting for a replacement part to be flown halfway across the world involves unacceptable delays.
Not to mention the risk of the shipment being intercepted.
Exactly.
So instead of waiting for a cargo plane, a military unit deployed in a disconnected or hostile environment can simply receive a heavily encrypted digital file loaded into the FX20 sitting in their forward operating base, and physically print the replacement drone part on demand.
It entirely decentralizes production.
Bit wild.
The earnings call also detailed the expansion of their surface mount technology, or SMT business. This division provides Tier 1 customers with the high-speed, high-precision assembly required for advanced electronics, printed circuit boards, and communications arrays.
So they're in electronics too.
Yes. And the technology itself is highly relevant to current global demands for domestic production. The challenge for the board of directors, though, is figuring out how to translate that vital technology into a financially sustainable business model.
Which requires looking at their 2026 forecast to see how they plan to bridge that gap. The fourth quarter data does indicate some stabilization. Management reported that their operating expenses dropped by 16% sequentially compared to their adjusted Q2 baseline.
That's a solid drop.
And furthermore, their adjusted gross margins improved to 49.7%.
That margin improvement is important because it suggests they are becoming more efficient at actually producing and delivering your machines.
Right.
Looking forward to the full year of 2026, they issued guidance projecting revenue between $130 and $140 million. At the midpoint, that represents roughly 30% growth. They also expect to narrow their adjusted EBITDA loss to between $40 and $50 million.
We should probably clarify what adjusted EBITDA loss actually means in this context, because companies love to use it to soften the blow of a net loss.
Oh, absolutely.
So EBITDA stands for earnings before interest, taxes, depreciation, and amortization. Basically, it's a way for the company to show investors the actual cash their core operations are generating or burning, stripping out the massive accounting artifacts.
Like the write-offs from the desktop metal bankruptcy we talked about earlier.
Exactly. It strips all that noise out.
It provides a much clearer view of the day-to-day cash burn. And while narrowing that burn rate to $40 million is an improvement, it still means the company is operating at a significant deficit.
Right. They're still losing money.
Yeah. So to permanently solve the structural issues of the business, the board initiated a formal strategic alternatives review back in September of 2025. They retained two major financial advisory firms, Guggenheim Securities and Houlihan Lokey, to evaluate every single aspect of the company.
So they are analyzing the product lines, their market position, and their core technologies to determine the fastest route to sustain profitability. Management actually committed to making a series of definitive announcements regarding the strategic review in the second quarter of 2026.
That's coming up fast.
Yeah. And as part of this overarching stabilization effort, they're also navigating the complex process of redomesticating to become a U.S. domestic issuer.
Which carries significant implications for investor trust. Currently, Nano Dimension operates under foreign reporting standards. By becoming a U.S. domestic issuer, they will be required to adopt U.S. GAAP generally accepted accounting principles.
The gold standard.
Pretty much. GAAP is a rigorous, highly standardized set of accounting rules mandated by the SEC. Transitioning to GAAP theoretically improves transparency and makes their financials instantly comparable to their American competitors, which is crucial for attracting large institutional investors.
Here's where it gets really interesting, though. The looming announcements from this strategic review are clearly dictating the company's current behavior, specifically regarding their massive cash reserves. And this created the second major confrontation with the analyst on the earnings call, focused entirely on stock buybacks.
Right. In late 2025, the company deployed a portion of its capital to repurchase its own stock, buying back 14.4 million shares for approximately $24.9 million.
Which is a decent chunk.
It is. However, during this call, management abruptly suspended any forward-looking commentary on future buybacks. They cited the ongoing strategic review as the reason for the freeze.
And analyst Moshe Sarsadi pushed back hard on this decision. At the time of the call, Nano Dimension's stock was trading at roughly $1.62 per share. The analyst argued that if management truly believes the company and its technology are undervalued by the market, halting the buybacks is just illogical.
Yeah, his point makes mathematical sense.
He pointed out that repurchasing shares at $1.62 is essentially buying $1 for 85 cents.
And the mechanism the analyst is referencing there is known as making a move that is accretive to shareholders.
Accretive.
Yeah. If a company has a massive stockpile of cash and valuable assets, and the market price of the stock drops below the actual per-share value of those combined assets, the company can buy its own stock at a discount and retire those shares.
So there are fewer shares overall.
Exactly. By reducing the total number of shares in existence, the proportional value and ownership stake of every single remaining share instantly increases.
Right. It's an immediate mathematical benefit to the people still holding the stock. So the analyst directly asked CEO David Stellan why they would pause something so obviously beneficial, especially when the company has nearly $460 million in cash and marketable securities just sitting on the balance sheet.
And the CEO's response was notably evasive. He basically declined to detail the capital allocation strategy and simply reiterated that things would become a whole lot more clear in Q2 once the strategic review concluded.
See, when a company with $500 million in the bank refuses to explain a basic capital allocation pause and points to a looming strategic announcement, it sends a very specific signal.
What's that?
They are hoarding that cash for a reason. Are the advisors recommending they use that capital to take the company private? Are they positioning the balance sheet to sell the entire enterprise to a major defense contractor?
The refusal to commit capital certainly indicates that the fundamental structure of the company is currently in play. The cash is their leverage, and they are locking it down until the board decides what the future of Nano Dimension actually looks like.
We started by looking at a headline claiming 142% growth, and we've uncovered a vastly more complicated reality.
To say the least.
We have a corporate entity fighting through the agonizing hangover of a chaotic 2025 acquisition spree. They are actively managing the financial crater left by a bankrupt subsidiary and attempting to overhaul their internal accounting controls.
Yep.
Yet at the exact same time, their engineering teams hold the keys to military-grade futuristic manufacturing technology that is actively being deployed to secure vulnerable supply chains right now.
And the tension between the glossy public narrative and the difficult operational reality, that is where the true value of financial reporting lies.
So fair.
The numbers on the page only tell you what happened. The footnotes tell you how the machine actually works.
So what does this all mean?
Well, I think it forces us to consider the intersection of corporate instability and geopolitical necessity. In a world where global supply chains can be paralyzed overnight by a regional conflict, a shipping bottleneck, or a pandemic, the ability to manufacture critical components on demand is just invaluable.
Absolutely.
The market will eventually have to decide how much financial turbulence and accounting chaos it is willing to forgive in exchange for the ultimate prize technology that can literally print supply chain independence.
That is the core question hanging over their upcoming Q2 announcements. If you want to understand the true trajectory of a company, you can never just read the headline. You really have to open the footnotes, track the cash, and see what they are actually building on the factory floor. Thank you for joining us on this deep dive. We'll see you next time.